Let's move to that other great conversation anchor in the world of quantitative finance. Factor approaches, factors, and what constitutes a factor in the first place, and is factor-based investing simple? Is it complex? Is it in fact something that one should stick with or something that should change? So I want to invite a pretty interesting and pretty knowledge-dense panel here. Professor Ravi Sundar Muthukrishnan. Where are you, sir? He is now currently, he'll be the moderator for this panel, and he serves as advisor to Antique, was previously a professor at IIM Lucknow. Can I invite Harish Krishnan, Co-CIO and Head of Equity at Aditya Birla Sun Life AMC. I want to also invite Deepak Shenoy, founder and CEO of Capitalmind, and Sukanya Ghosh, fund manager with SBI Mutual Fund. Can I please request you to take your seats in the order of your images, please?
I should start from that side, is it?
No, from here. So meanwhile, as has been the practice so far, let me tell you what Gemini told me about the opinions of these fine speakers. Professor Ravi, Rishi also informs me that his work on ModelWare is still quoted today. It's cited across research as one of the best analytical tools on factors themselves. Please. But I like this very interesting quote that while consistent valuation factors help, one must adjust for context. Harish has a very interesting opinion that factors, again, are valuable, but it's cyclical and predicting which factor leads next is hard. Deepak says that he prefers a core set of key factors and auto-regime detection through data rather than subjective switching. Again, in the world that we're in right now, these are all conversations that keep coming up. Sukanya, from sources, seems to be in favor of the idea of multi-factor investing. It helps reduce drawdowns and improve risk-adjusted returns. There is so much to unpack in this conversation. Professor, I'll hand it to you.
Oh, thank you. So thank you very much for getting us here to Bangalore. It's been a pleasure to sit in front of you guys for this conversation. I've done all that he said about a decade back, so I'm asking you to quant as you people are. I'm going to learn more from them today. But being a professor for 20 years, I've done a bit of quant during my professor days. These days I write on strategy, so I write more bottoms up than the quant. So, but then, with my experience of knowing Harish, Sukanya, they are some of the leading thinkers on quant. So to hear anything from them is going to be great today, I'm sure. So let's put the context, let's set the context. We'll ask all three of them, what do they do, especially in the area of quant? How big is the fund size? How is it performing? How is it performing relative to competition maybe? Is it scalable? So long as it's small, it's okay, but how much can it scale? All that stuff is something we'll ask each one of them. To start with, Harish? Oh, the ladies first. Okay. That's also interesting.
I manage the Quant fund in SBI Mutual Fund. Currently, it's around 4,000 crores. But in terms of scalability, well, it's a large cap universe. So yes, we think it is scalable as of now. We believe that quant in the large cap space makes sense. It's something that can give you some form of alpha. In the lower market cap space, there is still an active management piece that should work. So yeah, we think that large cap is very quant friendly, so we can move on.
Deepak?
Hello, yeah. So I'm probably the smallest guy among this stature in terms of number of crores and number of years of experience also perhaps in this, but I represent Capitalmind. We've just got a license to launch a mutual fund. We run a PMS. in which Anup actually does all the management, and I'm the guy who kind of demonstrates the charts. But we manage about 900 crores, 850 crores odd in the pure momentum as a portfolio in the PMS, and we have a few other factor-based strategies as well. And as a mutual fund, we hope to be able to access the retail public. Size is always a concern because liquidity comes and goes every single day. At some point, you feel that the strategies can manage a lot more. At some points, your liquidity comes down, and therefore you can, I think, largely related to liquidity and rebalance frequencies. But unfortunately, restricting universe ends up creating substantially lower alpha as well for us, at least from this thing perspective. So it's a combination of all of these. I think that determines your strategy. But I think any strategy will have to be adaptive in that sense to scale as it grows, either number of positions, rebalance frequencies, and things like that. And the depth in India has grown. I was talking to Harish also earlier. In 2008, to even buy or sell 30 crores a day was ridiculously difficult. And today you have more than 200 stocks that trade more than 100 crores a day. So liquidity regimes are very, very different. So when you do backtests also, you have to backtest with the thought process that liquidity wasn't as easy even 15 years ago as it is today. And today it will probably, again, there'll be an upper ceiling to the number of crores you can manage. Maybe it's 10,000, 25,000, 30,000, but whatever, there is a number. Beyond which even the factor that you choose or the strategy that you choose may not be quite as effective as otherwise. So it's just, I think, rolling limits in that sense. So while size is a challenge, I think reality is bigger. So if I'm at 900 crores and I'm talking 20,000 crores, I think I'm probably going to get a little bit ahead of myself.
So thank you, Prof. We at Aditya Birla Sun Life use Quant as a broad framework in three broad areas. First is what we called Quant assisted fundamentals, which is primarily about seeking the gauge of risk which the market is currently throwing. This we use quite extensively in our asset allocation products, where we run close to about 15 to 18,000 crores worth on this framework. The second is clearly about fundamental assisted quant, wherein we use our knowledge of fundamentals over the last couple of decades, but then let the quant strategies drive the entire end-to-end stock picking. So the rules and the codifying and the universe, etc., is what is coming from our fundamental research or our fundamental understanding, and then it goes into the machine. Over there, we have a strategy, the ABSL Quant Fund, which is roughly about 2,600 odd crores. And the third area that we use is, of course, to get better at what we do. We're a full stack fund house. On the active equity side, we manage close to about 2 lakh crores. Now, how can we use various disciplines of quant frameworks to manage that entire 2 lakh crores in a better digital, far more efficient workflow environment? That's the third area in which we use various quant frameworks. So this is broadly what we've gone through as a journey out here.
So we'll head this direction again. So single versus multi-factor. What do you think works? In your experience, and again, in the last couple of months, which of the factors which work the most? I'm sure Deepak has a lot to say on that, but I think your thoughts are also very important in this.
I think the short answer is nothing works. Okay, so if there is a holy grail saying that this is the factor or this is a set of factors that's going to blow the daylights out of everything and is going to give you repeatable, great performance every time, I don't think that strategy ever exists, right? But in a practical world, I guess what we are talking about is that, we need to blend in any strategy with the trade-offs, right? No strategy is perfect. And there needs to be certain variables that you want to trade off. One is, of course, the return frontier. What is it that you want to kind of optimize on? That is one axis. The second axis is clearly the scalability axis, which is that, what is the universe you want to pick out? Because lower down the curve, just like Sukanya mentioned that, there is a potential for alpha creation. Lower down the curve, there is a potential, I would suggest that there will be even larger potential in the smaller cohorts. But scale is definitely a challenge, right? So therefore, that's the other trade-off. And the third trade-off is really that of experience. So at least both of us and soon Deepak also is going to embrace the mutual fund world, wherein not everybody understands whatever we are saying. Forget factors, forget even basics that they're getting into. I mean, they may all nod their head, they may all say they are long-term investors, they are giving for a 5-year, 7-year, but the first hint of the drawdown, it sends them, have you made a mistake getting into this? And therefore, the experience element is very, very important. I mean, and therefore, it's this trade-off that you want to try and triangulate and try and come up with something which you want to optimize on. Now, if you want to optimize on returns, it's a completely different set of factors that you want to do it. If you want to optimize on capacity, again, a very different set of factors. If you want to optimize on experience, a very different set of factors. And so, therefore, in conclusion, at least given the fact that, we can't be launching 10 different quant funds optimizing on each scale, we choose a multi-factor kind of an approach because then at least, you've got all the 3 bases covered. To a reasonable extent. And so for our quant fund, basically it's a factor play on momentum in a very high quality universe, weight in low volatility. So that really is what our blend is, which, as quant practitioners, many of you may be aware of, is a conservative portfolio. Which is a conservative portfolio approach which has worked in various other regimes. We have adapted it to the Indian conditions using certain understanding, certain frameworks, certain behavioral patterns that we've observed over the course of the last 20, 25 years being in markets, and that really is what we have set out to do. So I would say, short answer, multi-factor over single factor, given what we are optimizing on each of these 3 dimensions.
Interesting. Deepak, we had this conversation the other day. You spoke about the non-reliability of fundamental data. So you basically thrive on market data. And you said you work mostly on momentum, right? Would you want to speak more on that?
Sure. I think I think perhaps I am an unabashed fan of momentum as a strategy because I think it kind of meets with a lot of behavioral criteria. Also, we're all humanly driven to like Virat Kohli when he's in form. And in that sense, a lot of behavioral aspects coincide with momentum as well. But more importantly, momentum on a back test. In terms of value, I think Anup and all will have substantially more data, but it seems to be the most outperforming factor taken singly without the combinational works in India. One of the other problems with some of the other strategies perhaps is data. Because what is revenue today is not revenue 5 years ago, because the accounting laws have changed. Balance sheets which were revealed once a year which were revealed once a year 15 years ago, now are revealed only 2 times a year. Profit and loss statements comes once in 3 months. Cash flow statements comes once a year. So it's a very different frequency. You have only about 20 to 25 years, 20 to 25 data points if you're testing a strategy in the past, and that is not really enough meaningfully for being able to gauge a significant amount of performance. Value comes, I think, a close second now. I think recently, as you talked about, I think value does really well from an angle here. But one of the reasons why momentum has maybe a little more this thing is because traded prices, for the most part, are trustworthy. I say for the most part because there are lots of manipulation in that as well. But to a certain extent, the traded price in liquid stock is more or less reliable, whereas almost everything else ends up getting restated in different ways. So low volatility, momentum, these are strategies which you can kind of have a little more reliance on. And in India, like I think Harish said, it's the depth of experience that matters. So suddenly 5 years ago, if I'm looking at the revenue of let us say, even an asset management company, the mutual fund, revenues are very different from what our revenues reported today, because earlier revenues used to be reported gross of including the commissions that you had to pay distributors. Today, revenue is reported net of that, as in commissions are paid to distributors first, and then revenue is recognized in the AMC. So there is, there's a difference in how revenue is reported and all that. A lot of this data cleaning work is tedious and enormous, and because regulatory definitions have changed, what is an NPA, what is this, what is that, you sometimes get bogged down with the scale of just being able to get the data to a point where you could analyze it comparatively from 2006 to now, which is about 20 years of data. And then you're looking at, well, if I'm going to do that colossal amount of work to get these things done, every time a new change comes, it also reflects back into that data universe as well. The problem in India is also finding the data providers has been enormously difficult. So more work tends to happen in they say this, if you give a person 1 hour to cut a tree, he has to spend 90 minutes sharpening the axe.
That's what fundamental data is.
That's what finding data is. I think that's the bigger point. Luckily, AI hopefully will help us do this even better, but the AI needs a lot of NI to just make sense of this whole thing going to the past. So I won't say that it's all bad, but one of the reasons I like Momentum is that, but then testability also from maybe because we don't have that much high quality data going back. Perhaps that is why also Momentum shines in terms of performance going back as well. But it does seem to significantly outperform.
Interesting. Your thoughts, Sukanya, on?
So we also believe that Momentum has done very well, but the way we look at multi-factor, and that's what we follow in our quant fund, is that we wanted to kind of map what an analyst would logically look at. So things that in general any analyst, any research analyst will be considering when they look into a stock. So putting that into consideration, we tried to create a factor-based framework where there are different factors or different parameters that every analyst will look at. So when you're researching a stock, you will look at the valuation, you will look at the quality of the company, but you'll also look at the momentum of the stock. So that's the thought process of kind of combining all the 4 factors. Yes, there are periods when certain factors have done exceptionally well, but then there are periods when those factors have had a huge drawdown. So multi-factor kind of helps in stabilizing the performance. And as Harish mentioned, that for us, it has to be something that is accessible to a large retail investor. So they should be able to understand it. So that's one of the reasons why we believe combining different factors makes more sense for us.
So before I go to Harish with the next question, I have some thoughts on data, especially when I did ModelWare. One of the things we thought that accounting, the financial statements which we all see every day are based on accounting gap, right? So for example, you take something like R&D. R&D expenditure is actually shown as an expense in the income statement because that is accounting mandation, right? So what we believed was that stock prices are not driven by accounting profit, they are driven by economic profit. So we used to go to great lengths to convert the accounting profit into economic profit. Likewise, the balance sheet, a lot of them are hidden in the notes to accounts. Significant items there is something like lease, operating lease, a financial lease actually having the features of a financial lease but being shown as an operating lease. These days, of course, they are actually shown as financial leases. Those days, companies had the lot of motivation to show a financial lease as an operating lease. So how do you go about converting that operating lease to a financial lease, then show that into the balance sheet, then recalculate your debt equity ratio? All that stuff we did. But at the end of it, we realized that economic profit or accounting profit, the markets have no clue about. But then it was interesting stuff we did then. So that's, And then after that, even today, if you see Morgan Stanley reports, they will have something called ModelWare EPS. So something which we created then is even being used today. So Harish, something more technical though. You might choose to say, I'm not into it, somebody else does it for me. How do you choose the factors? If it's a multi-factor model, how do you choose the factors? Do you bring in some economic factors also? Is there a certain amount of rigor you bring in your backtesting?
Yeah.
I mean, something there would be.
So I think, the core of the signal, because at the end of the day, there is a lot of noise in any signal, and we are trying to harvest the signal. Now, at least our understanding is that people get alpha from the market by being different from the market. And this is very core for our frameworks, the way we run. And therefore, when we think about multi-factor, or let's take a single factor to start out with, okay? When we take, say, the top 20% of a universe or the top decile, etc., you're getting a very small niche from the rest of the market, right? Which is only the top 20% or 10% what you have. Now, the moment you're going to get into a multi-factor wherein you're going to take, say, the top 20% of momentum, the top 20% of value, the top 20% of growth, quality, maybe even low wall, whatever you have, effectively, if you're taking all of that, invariably, and just doing a z-score and adding or any kind of computation that you do, you will end up being centered more and more into the market factor rather than moving away from the market factor, right? And this, we published a report along with Rajan Raju and myself, wherein we tested, for example, various index data that claims to be multi-factor in India, right? And then we saw that, compared to the pure factors that otherwise, what Pharma and French effectively found on the long short basis, how much exposure are they running on each of these, right? And what we found was that, in most cases, the single factors are still having a reasonable amount of statistical significance to that particular factor. But the moment it gets into a multi-factor, you are going to get invariably just the market factor. In fact, it was so hilarious that, we had an index which was called the value factor index, along with other things, okay? And it had zero value. Or no statistical significance of value. So therefore, we definitely don't want a KHD to come through, because then we are going to get the market factor, which any which case, through fundamental or through passives or everything else, investor has access to. We want something which is portable, which is different from the market. So that's point number one. The second point is in terms of the way in which we've gone about this rabbit hole is that, as Deepak was mentioning, we have very little data, or the extent of data that we have is very little. It's not like in US where you can test over 100 years and see how it is done in this macro regime, that macro regime, and then come up with something which. So at the back of our minds, every time we keep wondering, are we curve fitting? Are we doing anything that we are adding that is going to just be about curve fitting and which gives us the thing? And all of this in sample, out sample, to my benefit or to my understanding in India, given the fact that we've had broadly two regimes, which is 2002 to 2007, where there was one kind of a regime, 2009 to 2018 or 19 was a very different kind of a regime. You will invariably be getting the overall regime experience rather than saying anything about the underlying factors. So therefore, the way we go about doing this is we have a 9 test kind of a thing for every strategy. So every strategy has to go through 9 tests. Now, I'm not going to bore you with all the 9 tests. And some of them are obvious, like sharp, etc. But one of the things that we find a great focus is on the 60-day median returns of a particular signal. And if that has got certain amount of a deviation which is significant from, say, the base factor market returns, that is one. The second thing that we do, and because this is a quant-oriented thing, you may possibly appreciate it. There are 2 other things that we kind of focus on. One is, we take the universe, wherever we are drawing those lots from, and then we completely make 1 million random simulations of that universe. You can pick up random, let's say 20% of that universe, run it into 1 million simulation, and you get a whole range of NAV series, right, from the really worst and the really best, right? And then you start doing this with a frequency of rebalance of every, let's say, 60 trading days, etc. So you get a whole range of curves. And then you start seeing as to where your percentiles are of your particular strategy. Because that essentially is what, if I give a monkey to pick up, say, 20% of a particular universe, they would be able to pick up all of these things, right? And you can also do it with weights, whatever you're comfortable with. And then you start seeing where they are in that percentile and what is that acceptable percentile that you're wanting to catch. More importantly, I think, and this is from an active practitioner, if I were to look at where the market factor is, forget about any of these strategies, it might surprise many of you that the market factor is only at the 38th percentile on a long term, on a 3-year or a 5-year. So for all those who keep worrying that, or at least that's our belief, that, US has gone completely passive or a significant extent of passive, we are only at 38th percentile on a long scale as to where the market factor is. So there is a significant amount of potential if we want to capture it. So that's the second thing. And the third thing, and I'll quickly end here, is that, other way in which we look at whether we are robust enough in terms of our, output that we are testing, we look at the hypothetical, hindsight best and hindsight worst portfolios. Again, same universe, let's say you're running it every quarterly rebalance. We look at what has been the hindsight best portfolio if we had to choose, and the hindsight worst portfolios. Right. And every portfolio is always going to have, some exposure in this and some exposure in that. Do you have as a signal consistently high exposure into the right tail compared to the left tail? If you have that, then you've got a signal which is repeatable across regimes, right? And so these are the ways we lull ourselves to believe that, that this has validity. Because at the end of the day, any amount of testing beyond a point of statistics, given the fact that there have been only 2 broad regimes in India, I would say is, fooling ourselves, saying that this is going to work. Because the real world will always keep throwing a curveball that is going to doubt your conviction that this strategy is going to work, right? And therefore, coming to, one last point I want to make, which is that, each of our strategies or what we are saying needs to have a behavioral reason as to why we think this is working. We cannot be going just because saying that, the math says so or our output is suggesting that it is coming through. There has to be a basis as to why this is making sense. And because the point is, as a practitioner, when you're going through it in real time, you're going to be hit so hard, saying that, okay, this has happened, what should you do? What should you do? What should you do? And if at that point of time you start doubting your model, then the battle is half lost right then and there. You will never have the conviction to deploy, 500 crores. We are talking about deploying 20, 30, 40,000 crores on a model. We need to have that confidence that, we've done our work. So that requires a very different level of engagement and a level of conviction of having built the baby grounds up from first principles. If you don't have that, I would think that everything else is going to fail safe. Sorry, long answer.
No, it was an excellent, I think, a practitioner's view. Pretty excellent. You have something more to add to this, Deepak?
Yeah, of course, I think one more layer of this whole thing is how do you mix factors. So for instance, do you say that if I have a multi-factor fund, I'm going to have 30% momentum, 20% this, 20% that, and change the weights. So I might choose X number of stocks from the momentum factor, X number of stocks from, and then you kind of vary those percentages based on something, and I'll come to the something later. Or you score everything on each factor and find the highest scores consolidated across the factors and just take a portfolio of the top of those. So typical cross-sectional strategies, which is typically how...
Sorry to interrupt. The weights are arbit or just well thought of weights?
No, so you can determine the weights also based on something else. Okay. So it may be, for instance, one layer could be the performance of the factor itself increases its weight in the portfolio. Okay. The other one could be a completely extraneous element, like bond yields versus market earnings yields, or versus something like that, which kind of determines which factor will perform better based on a backtest. Or it could, the simplest way to think about it is if momentum is doing well, allocate more to momentum. And when momentum does badly from our last 3-month perspective and value does well, add more to value. So that would be a simpler kind of, I'm just giving examples of weighting systems, but you'll have to test these in different ways. But this is a different kind of a strategy where you kind of have buckets, and each bucket is individually momentum, individually something like that. The other one could be where you mix them all and say, I want stocks which have both momentum and value and maybe some of the other factors as well, which then score high, something that scores high on all of them together, then become my list of all the stocks I have in the fund. This is more difficult to achieve because a stock that is in momentum usually or many times will not qualify as value because this is like a battle of the eternity, right? I like cheap stocks, you like expensive stocks, and then never the twain shall meet. But eventually, the way to strategize multi-factor would be first to determine how you want to kind of have a multi-factor in place, and secondly, when you backtest or when you test some of these things elements, the weighting of individual scores. So should I give momentum an equal score, even when I'm doing a cross weighting across versus something else? So maybe that is sometimes deterministic, is usually taken subjectively, or you just do equal weight. I think what Harish described as the universe of all the different strategies you have, the market factor is lower than 50%, probably also because the weights of the individual stocks, because they're market cap weighted, are not the same, and therefore you end up with this 30%. Even equal weight?
Even equal weight is at 39%.
Okay, that's the sense of...
not that equal weight is at 50 and market cap weight
as 38. Yeah, I mean, so it is, but there will be differences in weighting returns on based on weighting itself. So the weighting itself becomes a problem. So, and this is factors. Beyond this is the factor related weighting to the individual stocks. So if I'm choosing momentum as a factor and putting a bucket against it, should I weight the individual stocks weight in my portfolio according to the scale of its momentum? So if I'm using a Sharpe ratio, the higher Sharpes get higher allocations and so on. So these are weighting criteria that have a very large dependence on, I mean, the returns depend on that. And lastly, the number of stocks you have and the rebalance frequencies, those also can change, because for instance, a fundamental strategy, rebalancing monthly is probably not very sensible because you're not going to get more fundamental data every month. Whereas a momentum strategy you can, whereas something that is 2 years long, and we did one market regime thought process where we said, what kind of market, can you get something that figures out if you go into cash at some point and in the market at another point, just switch between these two based on some external factor. We saw an external paper and we, I think, wrote an article about it, just using bond yields versus market earnings yields. The problem is the signal comes once in 3 years or 4 years. So you have to, as a fund owner, be in cash for like 4 or 5 years at a time. You will get fired mostly. The short answer is that, because in the end, if the market does go up and you're sitting in cash, you're not going to stay in this. But this had a great long-term return. And that long-term return was better than the market return over average, because by and large, it avoided a lot of the steep downsides. But however, it's not practical. So while it looks great on paper, you simply cannot implement it because you have to live every day at a time, whereas the strategy works in years. Right. So these are the other practical implications, because you'll have to deal with volatility and underperformance, both at the same time as a fund manager, versus, I mean, theoretical. More
Too much of technical, both of you guys.
Sorry about that.
So I think they covered a lot of what we as practitioners do. So stress testing obviously is something very important for any framework to, I mean, before you launch, you want to see how robust it is. The only thing, and one of the biggest challenges in multi-factor is how you weight the factors. That is the biggest question that everyone has in the mind. What, just one point maybe I can add on that is that something that we have seen is that factors have have some form of mean reversion, where at extremes there is there can be a regime shift of factor performance. So that's something that we try to kind of assess and kind of have tried to build it into the model so that we can pick if there is been an extreme outperformance of a certain factor or an underperformance of a factor, and there's maybe a change in the factor leadership. So that's something that we are trying to kind of add into the model. But yes, a lot of stress testing, a lot of questions that, and there is really nothing that is, you have to go on doing it. Even though you may have a live fund, you have to go on testing it because markets change and what may have been right in the back testing period may not be right currently. So that's something that we constantly do.
So 3 people with 3 very good ideas about how they go about. Good lessons for you people though. But about this factors, my take on that, generally what happens is, if you take the run-of-the-mill factors, especially when it comes to fundamentals, like your, say for example, ROE. ROE is such a common ROE, ROIC, all of that is commonly talked about. The moment the company talks about its ROE, the markets immediately discounts that information. So what we have done when we created some quant models is we tried to have proxies for these types of things. For example, for risk, for example, when we talk about risk, all of us talk about beta as a measure of risk. But we will probably use size as a measure of risk. The larger the size, the lesser the variability, both in the stock price, in earnings, all of that stuff. In place of ROE, we would have used something like return on operating assets. Not many people track it. That's a very useful set of information. Sometimes using that type of fundamental factors may help. We've tried that in the past. It's worked very well, actually. So 2 questions to all of you, in the interest of time. One question is, what are the new technologies in place now? What are the new sets of data? How do you look at AI? That's first question to all of you. Second question is, how do you get your colleagues who do mostly bottoms up, how do you get them to, use the type of output you get from your quant analysis? Yeah? No, you start.
With the AI.
You are AI.
Yes. So, it's great. I'm just fascinated with AI. I was a computer programmer in the past life, so this has given me a good reason to think I'm a computer programmer again, because I just open something and tell it write some code. It writes some code. It feels like I'm writing some code. So just put that aside. But actually, it makes my AI actually, if you have data, it allows you different ways of testing. So for instance, what Harish said, if I wanted to test it, build 1 million variations of portfolios, rebalance them every 60 days. There are 1 million into a number of 60-day intervals you have in your time series. Get that all together, show me a graph of it all. Today, I could say, write this out as a statement, and something will write the code that generates all of this if I have the source data. Whereas earlier I had to figure out which language, which syntax, etc. So that has helped in that sense, because you have a thought, you can translate it into something visual much more easily. Now, using AI to actually make decisions, I think this has been a problem in the sense of having an AI algorithm come out with something that is superior. Because as we are skeptical naturally, right, as system testers, you get a system that tells you this is great in terms of returns. The first question is, this is not true. It's just either unreal, or it's forward-looking, or it has incorrect data, or something like that. One of the things that happens usually when you have a test that looks too good to be true, it turns out that it is too good to be true. Because you'll test it back and you'll say this. So I think one of the things that is a problem with AI is if it came out with a system that was so too good to be true in that sense. Because of the nature of AI, you can't even question it, why is it too good to be true? Because even the AI doesn't know. It's by definition just using weights and trees and finding something that sounds great, but it doesn't know how it got there for the most part. And now you have AI that trains on AI input that takes AI output as input and then retrains itself. And by the time it reaches some conclusion, if the conclusion is do this, you don't know why it has told you to do this in the first place. So that these are the challenges in allowing decision making to happen through AI. But it's a great helper tool, I think. And it allows you to do a lot of testability much more in the in the organization. From the second question, the colleagues part bit, I mean, we're inherently very data oriented, though there is a lot of subjectivity that comes up to us naturally because it is not data oriented. So their Supreme Court judgment will come, on a certain stock that you own. Now what do? You have a quantitative strategy and there is a rebalance frequency, but there is some problem that is happening in this. There are subjective elements that you have to kind of think about at the same time. But as much as possible, that the statement of in God we trust, but otherwise everybody else bring data, is almost like a thing that we try to adopt as much as possible. And I'm going to use this moment for a small plug. We're hiring in case anybody is looking for positions. But yeah, the bigger thing is the idea that something has to be this thing by data comes down to, if you're saying something, that it has to be true with something. If you're telling me, even in a discretionary portfolio, if you're telling me that some hospital is cheaper than the rest of the hospitals, then there should be some effort in making sure that you've been able to cross-test that data, either primarily or using secondary data sources, so that you are able to kind of make that assertion with data itself. Now the second layer on top of this would be to backtest that data. I mean, in India, we don't have the level of data sources that, for instance, there was a test of these by people using satellite data to find out the number of cars in parking spots. So to find out whether a company is either hiring or a mall is getting more customers and so on. In India, in Bangalore, for instance, you would only have to buy because the parking lots are always full and the roads are always full. But even that level of looking at this data is not yet there. But I think as much as we try to make sure that everybody else kind of brings the data. And then quantitatively from a framework perspective, momentum is almost like an inherent piece. So the thing is, it actually works the other way. Think, if the stock is so good, why is it going down? That is the question we tend to ask when we get to a stock where we say something is cheap. Well, it's probably cheap because of a purpose. Look at the momentum is telling us it's not. And then you have to justify why it's not. That would become more of a subjective element, in that place.
So I'll answer both the questions in one point only. That's for us. We are mainly a fundamental fund house. So for us, acceptability of quant came, and also maybe accepting AI will come from the fact that can we explain it. So once the quant framework was able to explain the results and explain why certain stocks are coming in the portfolio, it was accepted in the research team as a tool that they can use. I think with AI also, if the model can explain why a certain result is being thrown, and which is happening slowly, I think we will also start using it. So we are not skeptics, but we are still in the periphery, just seeing what's happening, and hopefully we can use it.
360-degree stuff get you people to convince people with your quant models.
Sorry.
I mean, your colleagues, do they do a 360-degree when they try to pick up a stock with your help?
Yeah, so they obviously once they started understanding the model and they saw that actual their decisions could be also explained through a framework, they also came up with suggestions. So we also started using a lot of inputs from what they would be considering as things that they would monitor, and inbuild that into the framework. And so that helps in them, when they see their own parameters in the model, they start accepting it even more.
Yeah,
So
I get excited. Yeah, of course.
I'll come to the second question first, which is how do we get people to accept? Broadly, there are three edges in asset management, right? You've got the information edge, you've got the diligence edge, and then you've got the behavioral edge. Now, there are certain areas where fundamental human beings score significantly, and there are certain areas where there is a massive lacking of human beings. So when it comes to information edge, I think we all know by now that tech beats hands down anyone. Of course, in India, information is still a bit more porous. It's not as stringent as say the rest of the world, but we are making rapid strides for equal dissemination and symmetricity of information, so to speak. But in terms of data crunching, clearly, a lot of data crunching and the tools that can be used to crunch data through AI is something that the entire team is very, very openly embracing, okay? Now comes the diligence edge. Now, diligence edge is not about looking backwards, but looking forward. You have to look backwards also, which is to look at what the track record of the company has been when it has hit various speed breakers at various points of time. When there have been curveballs, what has been the response like? That gives you some base rate kind of a pattern of what the company can do. But the biggest leveler of alpha creation is when you have a variant perception on a particular company. Hey, this is what it has done, but I believe that it can do this because of XYZ reasons, right? Now, this can never be codified in a quant. At best, and the reason why I think momentum therefore is a great solution is because momentum is the wisdom of the crowds. It's basically trying to gauge what the crowd is telling and expressing in a particular stock, and therefore getting a behavioral sense as to that, okay, maybe there is a diligence. But over there, I would still think that human fundamental analysis scores hands down over any kind of a wisdom of the crowd. Now comes to the third part, which is that of the emotional area. Now this is where human beings suck, okay? How much ever you can train a human mind to be contrarian or non-linear in thinking, they will never be able to do that. Because they know that, the echo chambers around human beings can influence them. When things are good, all we get to hear is good things. When things are bad, all we get to hear and amplify are the bad things. Now this is where a model really helps, which is that of quant. So as long as you start explaining to the team that to what is it that it can help you in and what is it that it can't help you in, I think there is a better acceptance of it. But it still is a significant amount of effort because they're not used to it, right? It is not that they are, so to start out with, and maybe that will be the point on, see, I'm an AI skeptic, not because I don't think it's a wonderful tool. I think it's a great tool. Yeah. But I don't think that any of us are going to lose our jobs because of AI. I mean, the fact that Warren Buffett could, or Charlie Munger could be in the 90s and be as sharp as ever and managing money, and because they were so good at it, I think any of us can really do it because markets work not on the first degree of thinking, the second degree of thinking, right? So how can a model really codify the madness of people is something that I really want to see. You can try and gauge what they can do with one person. Can they do it for the entire crowd? And once they are able to do that, then the markets will go to the third degree of thinking. There is no end to how many layers. This is like the Inception movie, right? As long as markets, people make money by being half an edge or half a step ahead of the rest of the market. That's all it takes. And so if you think that the AI is going to be 2 degrees up, there'll be some smart person who will say, I'm going to be 2.5 degrees now thinking, and that is enough to make money. So I am not so certain that, the need of human beings and their ability to think differently is going to go away just because there is a machine that's going to dumb down. But a lot of easy things like what Deepak and Sukanya said, a lot of those things can definitely go, and it'll free up the creative mind space of human beings to really think as to what can be possible by an enterprise. And therefore, that is where I would think it's going to be a lot sharper. Last point. Again, it's a great book, The Paradox of Skill. I'm sure many of you may have read it. And it's exactly the same thing, right? When the skill levels keep improving, increasing, the role of luck becomes that much more important in determining the end value, right? So if you think that AI is going to up the skill of everything, then the role of human being, the role of the luck that a human being comes, and luck, I'm not saying in a negative connotation. The differentiation from what it can bring through, I think will work very, very beautifully. So that's at least where we are thinking about AI. Thank you.
Yeah, most of what you said on AI I completely concur with. Nobody can take away the human mind. But yeah, we have taken away their time also. But yes, we will, how much time? 2-3 questions are okay? You may want to name the person who you want to ask the question, or you can generally say anybody.
Yes, sir. Yeah. Hi, I'm Madhav. My question is for Mr. Deepak Shenoy. Momentum, I definitely agree. I presume it's the medium-term momentum that you were talking about. But when momentum pulls back, I could be wrong, but it tends to pull back a bit more violently than other factors. When momentum pulls back, when there's a drawdown in momentum, my observation is that it has been a little more violent than the drawdown seen in other factors. Has that been the experience in your case? And if so, have you been able to, foresee it or something like that? Thank you.
I want to be able to foresee. We all want to be able to foresee this. So let me just say that there's no doubt about it. The practicality of trying to foresee it has challenges. The other one is, yes, is it more volatile? I don't think so. There are 206 factors. I don't think it's the most volatile of them all, or has most downside capture of them all. But there are times in which momentum will hurt more, and it depends on the way you define momentum. There are do you have cash at all in your portfolio? Sometimes a fund by definition cannot have cash, therefore they suffer the entire volatility. But a strategy that allows cash positions may not have as much downside capture. But yeah, this is one thing. And we are all working on the same data. I think that is why momentum works, because we are all working at on the same 26 or 25 or 30 years of data that we have. But if you look at some other markets, momentum may not have worked quite as well. So there are other things that work in different markets. So you'll have to adapt based on the underlying data itself. And then if your commodity trades may have a different definition of momentum than when you do equity stock trades long only. If you're equity long and short, a different set of strategies may work. So momentum may not be the only thing. I'm just saying that, yeah, there are downsides to momentum, but not necessarily, it's not necessarily the worst downside of them all.
Hi, this is Akshat. So question to Harish sir and Deepak sir, both of you. So if the question more or less remains, you were speaking about blending versus sleeve versus filtering, as you mentioned, right? So if I were to blend scores and then I do a regression, the R-square value substantially reduces and the idiosyncratic risk of the portfolio increases substantially. So which approach of the three is the better of it to do if I were to do it?
So at least my observation is, like I said, blending factors by addition, etc., gets you closer to the market factor. Okay, so at least our approach is like how a chef uses all these ingredients. Okay, you don't put the same amount of salt, you don't put the same amount of protein. Each one has a different thing. So there are broadly 4 signals or 4 ways in which we can influence these signals. One is the universe. Second is the signal itself. Third is the weighing, and fourth is the rebalance. Okay. Now you can create a multi-factor thing by getting in factors in each of these 4 things. You don't have to necessarily spruce everything only in the signal, because then you're going to get more of the market factor. The moment you use each of these for each of these other 4 ways, then possibly you will be getting the benefits of each of these factors in a very different way, and still having a niche in the market, right? So that's at least our experience, that we tend to use each of these factors for any of these 4 objectives, rather than using them in the signal. Because for us at least, we have not been able to crack getting all the 4 signals or all the 4-5 factors together as the main signal. Yeah, so that's at least our observation.
A quick thing here is, I think what you're talking about as blending is more like soup, and keeping them sleeved is more like a salad. In a salad, you can taste every ingredient. In a soup, everything kind of mixes and comes together, right? So in that sense, in most cases, blending is like a compromise. It may work in certain cases, but sleeves are more identifiable, and like he said, I think do the rebalance bits. The other factors that you have to consider is two areas. One is, are you a closed-ended fund, where your incremental cash flows don't allow you to rebalance as effective. There's no incremental cash flows, so other than dividends maybe, or interest payments. So it doesn't allow you to do rebalancing more effectively. Whereas if you're more open-ended, cash flows allow you to naturally create rebalances which are more timely, or more, you don't necessarily have to sell in order to do a rebalance.
Right.
Because fresh inflows help you. And then transaction costs, which are very different in India and very different for a long only stock portfolio versus a long futures slash this thing portfolio versus a portfolio in the US. So these are two layers which will affect all of the ratios, all of the weightings and the rebalance frequencies that you want. Because you could weight something as much as you want, but if the weight diverges because of market prices, your rebalancing itself has an impact. And that impact cost will include transaction costs, which can change your backtest nature of a strategy like that. So I'm sorry, I just added more confusing terms to the mix, but you know.
No, I am.